Hello and good evening. Welcome to episode 20 of this mentorship. So, we'll be discussing the concept of openings. So, opening prices and why are opening prices important? The basic models, the basic concepts that will be used in these models will be the first one will be the concept of power of three, and the second one will be on time and Q zones. So these two basic ICT concepts is what will be used for this module, for this episode. So openings, what are opening prices? So there is multiple types of opening prices when it comes to algorithmic trading using ICT's concept. First and foremost, you must first understand the inner workings of a candlestick. We previously mentioned something like this in the past about how the candlesticks were being delivered in the past. So previously, for a up close candle, that is a green candle or a white candle or a bullish candle, whatever color your bullish candle is, it you generally get an opening price like this. Then below the opening price, trades will go lower to manipulate sellers to come into the price to sell at a lower price, and this will be picked up by smart money traders. So you have a low like this, and then price will expand higher like this. Now, when we're expecting for a bullish candle, when we're expecting a bullish candle to unfold, we do not pay attention or worry ourselves about the closing price of that candlestick or of that trading range, that specific trading range in price. So we do not necessarily concern ourselves with the closing prices. So we are more focused on the opening prices and where it is likely to expand towards to. So the opening prices and the expansion. So this opening price now, it is extremely vital to understand, especially when aligning yourself with the concept of power of three, especially when you are implementing the concept of power of three within a specific trading window when you are trading. So there are multiple opening prices, so you can write this down on your journals, and the more you tape read and practice this set of concepts by yourself, the more it will be revealed to you on how to make use of these opening prices and the narrative being gotten from these prices, these opening prices, and how to use them as narratives to facilitate a trade idea or a bias in price, or to derive and formulate a narrative from scratch. So let's start. The most obvious opening, we'll be talking more specifically on the indices market, but this concept also works in forex. It's just a little bit slight differences when it comes to the opening prices at New York time for the forex market as compared to the indices market. Every other thing is basically the same that we're about to discuss here. So the first opening price I want you to note is, so we're listing just the basic opening prices. So the first is the midnight opening price. So first and foremost, before we align ourselves with these charts, with what we're about to do now, I need you to go to your trading view here. This is your time zone, and set it to New York trading. So you must be set to New York so that you can align yourself with what we are doing here, because everything algorithmic as as it relates to price, it's being delivered on the New York time zone. So that is it. Right. So first and foremost, you want to note the opening price, which is you want to know the midnight opening price. That is the midnight for New York, which is 0:00 o'clock, which is this is the midnight opening price for New York. Then the second opening price, the second basic opening price you want to note is the 8:30 a.m. opening price. So there's an 8:30 a.m. window when the equities market, when it is the opening price for the morning session. So this is standard 8:30. Typically this time, this is when there's news releases. News releases comes up at this time most of the time. Then you have the next opening price you have is the 9:30 equities open. So at 9:30, this is when the equities market officially open. This is when you get the bell. This is when you hear the bell for the equities market. So here, this is the equities open. So when stocks start trading, it starts at 9:30 opening. This is when you get the opening bell. And then you also have what's standard important opening price. These are the basic opening prices. I'm trying not to add the afternoon session because we are more focused on the morning session in this mentorship. But let's just add it. Let's just add it. So we have for the afternoon session, we have the 1:30 p.m. So you have the 1:30 p.m. afternoon opening price. So these are the standard opening prices. So for the power of three, when you're expecting, for example, you're expecting the lower prices, then price opens up here like this. You're expecting price to trade for a lower prices. Every time you're expecting lower prices, you're expecting the manipulation leg to take place higher above the opening price. The opening price you are using at that particular time frame, at that particular trading session, it is all based contextually as to what narrative is in play and what session are you trading, what Q zones are you trading. Are you trading the London session? If you're trading the London session, which is the 2 a.m. to the 5 a.m. window, you are more focused on the midnight opening price. That is the New York midnight. So, and if you're trading the New York morning session, you are more focused on the 8:30 opening price and other times the 9:30 opening price, while keeping in mind the narrative as it unfolded during the midnight opening price at New York. So each opening price this you're using is all based contextually. So when you have an open here for a bearish candlestick, for a bearish intraday price action, when you're expecting expansion to the downside, you're expecting a manipulation leg above the opening prices. So you're expecting a manipulation leg higher. So when you get this manipulation leg higher, price will pair up. This is when smart money traders will be pairing their sell orders. They'll be loading in their sell orders, expecting an expansion leg to the downside. So when you get that leg lower, when you get that drop lower, this expansion leg you're expecting, this is the move we want to participate in. This move, this is what we want to partake in. Some traders they will trade this manipulation leg higher. But when you are trading like this, you are trading against order flow. So, but that is, by the way, that's not what we're discussing currently. So when we price trades higher above the midnight opening price, then price will drop lower. Yeah, we do not concern ourselves with the closing price of that asset. So price will close wherever it wants to. There are tools to get precise closing prices to understand where price is likely to close, but we are not concerned with it. We are concerned with taking a large portion of our profit when losing this expansion leg lower. We are not concerned about taking everything from the marketplace. We are concerned about taking our portion, what the market offers us, and then we split out. So these opening prices, these are the basic opening prices. Then you have what I regard as the exotic opening prices. So these exotic opening prices we start. So the first exotic opening prices of concern for me is the opening prices when price opens at Sunday's opening time. So there's a open at Sunday. The market closes at 16:55, at 16:59 at on Friday's trading. So that is at 4:59 p.m. the market closes here. So this candle here is the close of this candle is 5358.00. This is the close of this candle here. And when it opens up on Sunday's trading, it opens up at the opening price here is 5330. So this opening price is the opening for the week. When the week starts trading, the first 1 second candle that prints at Sunday's opening price. So here you have the new week opening price. So new week open. So this is when price open. So this is the new week open. So you have the new week open. So this is the first exotic opening price for me. Then you also have the opening price daily. So when the market closes at 16:49 p.m., it opens the next day at the next trading window that opens up after that closing price is the one at 6 p.m., which is 18 o'clock. So you have a 6 p.m. open. Let's 6. So you have a 6 p.m. opening price, which is 18 o'clock. Let's call this 18:00 slash new day, because it's a new day. It's a new trading day. So you have a new day open. So this is another exotic open. These two opening prices are vital when reading price action, because this is when price opens up after it's a clear close of price action. Because for example, when you're talking about the New York trading window and you say the New York trading opens up at, let's say, 8:30 and the morning session closes at 12 p.m. During after those closes, there is no pause in trading. There is no significant pause in trading as compared to these time windows, this new week open and this new day open. For the new day open, you get at most 1 hour, so at least 1 hour window of a no trading window. While for the new week open that opens up on Sunday, at least you get about 2 days, which is you have from that Friday's closing through Saturday 1, then Saturday through Sunday 2. There's about 2 days of no trading. So these two opening windows are not compared to these opening windows. These opening windows are algorithmic. These opening windows are more based with, they are more fixed to say. They are, so that's it. So another of the exotic opening is the opening range gaps. So opening range, yes. So you have the opening range. Let's say the opening range. We put the gap in bracket because it matters. It only takes effect if it's a gap price action, if it's a gap opening range or not. Sometimes, most times, price just continue to trade. at its previous opening range close. When price closed the previous day's trading, price just continues trading from that particular price point. This happens, but not every time. So the opening range gap, what is it? This opening range gap is from the closing price of that from 16:49, sorry, from that 16:59 p.m., which is that 4:59 p.m. closing window. When you toggle your trading view, so on your trading view, if you toggle this electronic trading hours, if you toggle this to regular trading hours, so you're only focused on this regular trading hours windows, this is what you get. So this is how price presents itself to you when you are looking at when you're looking at it from this perspective, from using only the real time, using only using the when you toggle it from electronic trading hours to regular trading hours, this is how the market presents itself to you. So if you notice, after the close, after the close at 16 at 4 p.m., after you have this close here at 4 p.m., yeah, the market stops trading and then it resumes the next day at 9:30 open, which is the equities open we talked about. So the opening price it opens at, that's next day it is, this is the opening range gap. So this is the opening range. We call this the opening range gap. Why I'm using the term opening range gap, it's because there's also an opening range from the 9:30 open to the 10 a.m. open. But that's, by the way, let's call this the open range gap. So because it opens lower than the previous day's closing, so call this the opening gauge range gap low because it's at a lower price as compared to the previous day's trading. So let's put this here, or let's make this middle as it was. So this opening price, when price opens here for a bearish candle, this is a bearish candle. So when it opens here, this is an opening price, and this is the closing price for that trading. This is the opening range gap high. So during this trading window, there is no price action, there is no trading going on because this is the United States market, this is the equities market, and it's once on the New York time zone. So we are only focused when trading this time, this when using this opening range opens, we are focused on using the close of the previous day's trading and then the opening at 9:30 a.m. trading. During this opening range gap, there will be sensitive price action towards it, on it. The narrative in play will determine how you operate using this opening range gap. So they are all based contextually. When you have a general understanding of these opening prices, it will give you a streamline and more precise dealings in your price, especially when you are using the concept of the power of three. Because for the power of three, you have three phases, which is the accumulation of smart money orders. Then you have the manipulation, which is intended to trick and speculative uniform money. To it will be needed to trick them to go to the opposite direction as to the intended move in price. Then you then have the distribution phase of that power of three. So, and this is the power of three concept. It is more vital to incorporate the concept of time when while using it, because those time windows, those Q zones, it will give you a more precise dealings when dealing with price. That this doesn't mean that this concept doesn't work outside of those Q zones. The reasons for using those key zones is because those are business hours, and when you're operating during the business hours, there's more precision in predicting prices. There's more professionalism because that is a market time. It's like when you're on the road driving, if you're driving at 2 a.m., most times the road is free at 2 in the night because the general public, they are sleeping most of the times. So the road is free. There's little to no traffic. So if you are a street hawker, you're selling something on the street, that is not a good time for you to open shop at 2 a.m. in the night because your customers are not awake then, because the people driving at 2 a.m., they are not driving to look for food. They are on a different mission, but that's by the way. So you want to open your shop when there is traffic on the road, when it's a busy time, when it's a busy time for the road. For example, the morning time, if you're selling probably bottled water on the street or something like that, you would want to open at 8 a.m. to like probably 12 p.m., 12 noon, when the sun is scorching. And during the afternoon window, you want to be operating in those times because there's more participants in the marketplace. And using these opening windows, it will streamline your understanding, your focus on operating and understanding the narrative that is in play. So, and there's more opening prices. For example, there's a opening price for New York trading, which is the 2 a.m. open. So there's a way you use those 2 a.m. open. There's a way you use that 2 a.m. open to calibrate your narrative of price action for that New York session, or using that open at New York to understand the next course of action, the next phase of distribution or reaccumulation during the New York trading, because most of the times the New York trading is a continuation from the London, what already happened during London's trading. So you have a continuation of London's trading during the New York trading, and as if the London trading does not present a signature for a continuation pattern for the New York session, the New York session will be anticipating to deliver a reversal profile. So you see, use these openings to derive narrative from a specific trading window, to either use to trade that specific trading window, or use that narrative to understand the next trading window or the next trading queue zone, to understand how to participate in that trading window using the element of the trade setup. When you get a consolidation, you're expecting a form of expansion. So stuff like that, you blend these concepts together using the opening prices to get your precise understanding of that theory that is being passed across. So I hope you got something from this video, and thanks for watching, and have a nice day, and goodbye. Talk to you in the next episode.